We're going to do our first multi-picture deal with our Hallmark romantic comedy series. In this three-picture deal, we start with the first picture. The first movie we're going to do is a Hallmark-like romantic comedy called Love in Saint-Tropez. We did a deal with the sales agent Nicely Entertainment, who is known for doing these romantic comedies that are sold to Hallmark, TLC, and television networks that do air the Hallmark-like destination romantic comedies. So this movie is going to be $750,000 in the budget, for the budget. And so we're deciding to work with Nicely Entertainment together, and we each would provide 50% of the budget as equity. So we're basically financing the $750,000 movie fully in equity, each providing 50% of the budget. Nicely will charge us a 20% fee, and they give us revenues to project. They think they can get 65% of the budget from the US, and then 55% of the budget from international marketplaces. So they will look at the international at 55, lower than what we normally see with our films, but this is not uncommon for a romantic comedy like this. That is a Hallmark type comedy with actors that are known but not too known internationally, which is why this rate is lower. But this often is the kind of content that works well in the US, which is why 65% is projected for the US. The film is shot in France, and we're hiring a local co-producer to do this, and we're generating 35% of the budget in France. But we're not going to take this to a bank or get a loan. We will produce the movie, send in the receipts, and get the incentive after the movie is finished. So we're treating this like revenue, and we both agree that we each benefit 50-50 from that revenue. So when you look at the finance plan here, we see the international take estimates at 55% of the $750,000 budget. The US estimated at 65% of the $750,000 budget. So altogether, we're generating about 120% on this movie, making $900,000. So there is no pre-sale, there's no loan. So Nicely is financing $375,000, and we, the producer, are financing $375,000 to cover the $750,000 budget. So when we look at the recoupment plan, we see that we got $900,000 in worldwide distribution revenues as projected. The French incentive is coming in at 35% of the budget, which is $262,500. So our total revenue is $1,162,500. The collection agent charges 1% of that. The Nicely sales fee is 20% on everything. And the equity investment that Nicely gets is $375,000 plus premium, and so do we. So altogether, we have expenses and costs totaling $1,091,625, which, if we deduct this from our total revenues of $1,162,500, leaves us with net revenues of $70,875. So we're sharing this, which means each of us gets $35,438, and together with the premium that we each generated of $75,000, we generate a total of $110,438 in relation to our investment of $375,000. So that is an ROI for each of us of 29%. Let's compare this with a three-picture deal and see what that looks like. So in this case, because we're doing a kind of a three-picture deal volume, Love in the French Countryside, which is a franchise, Hallmark will pay us $500,000 per film. And Nicely agrees to cash flow that, but it wants 30% in interest, and it wants to be paid in the waterfall. So we have to look at the interest payment to them for cash flowing this $500,000 times 3, so that's $1.5 million, and getting their 30% on that. So since we're producing 3 films, the budget is now for all 3 films $2.25, and we're saying we're not going to increase our investment. We're each going to stay with $375,000, even though we're going to do 3 movies. So we're basically taking the $750, dividing it by half, and applying it to a 3-picture deal. And so again, we are co-financing this, and Nicely will still again charge 20% of sales fees. We're thinking we can make 75% of the budget in the US and 55% in the international, but we're going to see with the Hallmark deal how that would actually look like in regards to revenues. And again, the films are shot in France, which will give us 35% of the budget as an incentive once the film is recouped. So the finance plan here shows us that we're going to take 55% from the international market for the 3 films. 55% of 2,250,000 is 1,237,500, and then we have the Hallmark deal in here for 1.5 million for the 3 films. So altogether we're generating 2,737,500. Then Nicely's cash flowing 500,000 per film, so 1.5 million. And then we're both putting in the 750,000 in equity like we had before, to then come to 2,250,000 for the 3 films. So let's take a look at the recoupment plan for this. We are looking at the international distribution revenues for the 3 pictures of 1,237,500. We have the Hallmark deal coming in at 1.5 million. So the total distribution revenues are 2,737,500. And then the French incentive comes in for all 3 films at 787,500. So in total we have 3,525,000 from the incentive and the distribution revenues. So Nicely wants its loan back in first position outside the collection account, so we're paying them from the revenues 1.5 million plus the 30% interest of 450,000. So that leaves us with a balance of 1,575,000, which is then running against repayments and expenses. First, the collection agent at 1% of this, 15,750. The sales fee to Nicely, 20% of 2,737,500 is 547,500. And then we each get our $375,000 equity investment back, which is then giving us a profit, a net profit, I should say net revenues, in fact, of 111,750. So when we're looking at the recoupment plan, we can see that the ROI is slightly better for everyone. Nicely is getting their 450,000 in interest, the premium of 75,000, the profit of 55,875, because they gave us the cash flowing amount for the Hallmark deal of 1.5 million plus the equity investment of 375,000. So their ROI is 31%. The producer, which is us, we receive our premium and our profit. That gets us to 130,875 on a $375,000 investment, which is 35% ROI. So ROI increased by 6 points because we're doing a 3-picture deal with the same investment that we used for the 1-picture deal.